Hello, and welcome back to Tax and Financial Matters, the channel where we discuss various topics related to tax and financial matters. In today's video, we'll be discussing the EU's Anti-Tax Avoidance Directive 2, or ATAD 2. This directive targets hybrid mismatches, which are tax planning strategies that exploit differences in tax systems across countries. So, let's dive in and learn more about ATAD 2 and its impact on the European tax landscape. Background and overview. Before we explore ATAD 2 in detail, it's crucial to understand the context in which it was introduced. The European Union has long been concerned about tax avoidance and aggressive tax planning by multinational companies. In response, the EU adopted the first Anti-Tax Avoidance Directive, ATAD, in 2016, which provided minimum standards for combating tax avoidance. However, ATAD alone was not sufficient to address all tax avoidance strategies. Consequently, the EU introduced ATAD 2 in 2017 to specifically target hybrid mismatches, which are a common way for multinational companies to exploit tax differences between jurisdictions. Hybrid mismatches explained. Hybrid mismatches occur when two or more jurisdictions treat a financial instrument or entity differently for tax purposes, resulting in double non-taxation, double deductions, or other tax advantages. These mismatches typically arise due to differences in the characterization of payments, entities, or financial instruments. For example, let's consider a multinational company that issues a financial instrument treated as debt in one jurisdiction and equity in another. The company may be able to deduct interest payments in the jurisdiction that considers the instrument as debt, while the jurisdiction that treats it as equity may not tax the corresponding income. This mismatch results in a tax advantage for the company. ATAD 2 Scope and Rules. ATAD 2 addresses hybrid mismatches within the EU and between EU member states and third countries. The directive lays down a comprehensive set of rules that target different types of hybrid mismatches, such as hybrid financial instrument mismatches. ATAD 2 denies the deduction of a payment if it is not included in the taxable income of the recipient or if the recipient is also allowed to deduct the payment. Hybrid entity mismatches. The directive requires that a payment made to a hybrid entity be treated as non-deductible in the payer's jurisdiction if it is not taxed in the recipient's jurisdiction. Imported mismatches. ATAD 2 targets situations where a hybrid mismatch is shifted to another jurisdiction through a non-hybrid instrument. In such cases, the directive denies the deduction of the payment made under the non-hybrid instrument. Reverse hybrid mismatches. ATAD 2 addresses cases where an entity is treated as transparent for tax purposes in its jurisdiction but is considered non-transparent in the investor's jurisdiction. The directive requires that the entity be considered non-transparent in its jurisdiction and taxed accordingly. Implementation and impact. ATAD 2 came into force on January 1, 2020, for most of its provisions, while the rules regarding reverse hybrid mismatches are applied since January 1, 2023. EU member states are required to implement the directive into their national legislation, ensuring that companies operating within the EU adhere to these new rules. The introduction of ATAD 2 has significantly impacted multinational companies, requiring them to review their existing structures and arrangements to ensure compliance. While the directive aims to create a more level playing field in terms of taxation, it also increases the complexity of cross-border tax planning. I will provide you with 3 examples illustrating the impact that ATAD 2 has on cross-border tax planning. Example 1: Hybrid financial instrument mismatch between Luxembourg and the United States. A Luxembourg-based company, Luxco, issues a convertible bond to its parent company located in the United States, USCO. The convertible bond is treated as debt in Luxembourg and equity in the United States. As a result, Luxco is allowed to deduct interest payments on the bond in Luxembourg, while USCO does not include the corresponding income in its taxable base in the United States due to its equity treatment. Under ATAD 2, Luxco would be denied the interest deduction in Luxembourg because the corresponding income is not included in the taxable income of USCO. This eliminates the tax advantage resulting from the hybrid mismatch. Example 2: Imported mismatch between Luxembourg and Switzerland. A Swiss-based company, Swissco, issues a hybrid financial instrument to a Luxembourg-based company, Luxco, which is treated as debt in Switzerland and equity in Luxembourg. Luxco then lends the funds to its subsidiary in the United States, USCO. The interest payments from USCO to Luxco are deductible in the United States, while Swissco's payments to Luxco are not included in Luxembourg's taxable income due to the equity treatment. Under ATAD 2, the interest deduction on the loan between USCO and Luxco would be denied because the hybrid mismatch between Swissco and Luxco creates double non-taxation. This eliminates the tax advantage resulting from the imported mismatch. Example 3: Permanent establishment mismatch between Luxembourg and France. A Luxembourg-based company, Luxco, operates a warehouse and logistics center in France through a branch. The branch constitutes a permanent establishment, P, under Luxembourg tax law, but France does not consider it a P due to differences in the interpretation of the tax treaty between Luxembourg and France. As a result, the branch's income is subject to tax in Luxembourg but exempt from tax in France. Under ATAD 2, the income of the branch would be denied a deduction in Luxembourg to the extent that it is not subject to tax in France. This would eliminate the tax advantage arising from the PE mismatch between Luxembourg and France. Conclusion. In conclusion, ATAD 2 is a critical component of the EU's efforts to combat tax avoidance and aggressive tax planning by multinational companies. By targeting hybrid mismatches, the directive aims to reduce opportunities for tax arbitrage and create a fairer tax environment within the European Union. Companies operating across borders must stay informed about ATAD 2's provisions and ensure they are in compliance to avoid potential penalties. Thank you for joining me in today's discussion on the EU Anti-Tax Avoidance Directive 2. If you found this video informative, please give it a thumbs up and subscribe to our channel for more content on tax and financial topics. Until next time, stay informed and take care.